Hey guys, what's up, how's it going? My name is Rob and welcome back for another video. In today's video, I'm going to be focusing on two major ETFs. We're going to be focusing on VTI and XIC. So we'll be comparing two total stock market funds, one fund that is US based and one Canadian based. So I'm going to go over the differences between the two funds. I'm going to give my thoughts on what I think about investing into the US market and the Canadian market. And of course, because this is a Canadian themed channel and I'm a Canadian based investor, I'm going to be kind of focusing on the perspective of what I think is the best kind of approach to take when it comes to investing as a Canadian. And if you guys want to pick up these two funds, you guys can do so. I'll put some links to Wealth Simple Trade in the description of this video if you guys want to support the channel. So let's get inside the video, let's take a peek at these two funds and let's compare them and see which one is better. Alright guys, so the first thing we're going to be focusing on is going to be the fees, or the MER, the management expense ratio of these two funds. Now the cool thing about these two funds, VTI and XIC, is they actually have very, very low expense ratios. So I got these two things brought up here side by side. I'm going to try and do this video like this, so let me know what you guys think of this cool little format. But basically we have VTI on the left side here. This is the Vanguard fund, the total US stock market fund, and then we have XIC on the right side, which is a BlackRock market fund. And the expense ratio for VTI is 0.03%, which is very, very, very low, as you guys know, and that's pretty much non-existent. And most Vanguard funds have pretty low expense ratio. So this fund, basically no fee. I would say it's very, very little, if any existent at all. And then we have XIC with a management fee of 0.6%. So slightly, I guess you could say it's double the fee of VTI, but really 0.06% once again is pretty much non-existent in my opinion. That's super duper low, and the fees for both of these portfolios are very, very low. So that makes them very attractive to start with, and you're paying very low. I'd say anything under 0.5% is very low fee, and obviously these funds are some of the lowest fees you can get. The second thing we're going to be looking at is going to be the holdings of each individual portfolio. So you can see how the different exposures, we'll talk about the different stocks, as you guys will see here, and then we'll go over the different sectors and see the different exposures and what you can get with each different fund. So the VTI fund has some of the biggest US companies, as you guys will see. And here's the different holdings here. We have Apple as the #1 holding. We have Microsoft, Alphabet Incorporated, which is Google. We have Amazon, Facebook, Tesla, Nvidia, Berkshire, JP Morgan, and Johnson & Johnson. So those are the top 10 stocks inside VTI, and those are some of the biggest companies in the US, and you can expect that. And going over to, and it's quite a bit like a mix. There's a lot of tech stocks in there, like Apple, Microsoft, Google, Amazon. I guess Amazon is more like e-commerce, if you want to call it that. Facebook is, I guess you could call it tech stock. Tesla is kind of like a tech stock / car, automobile, whatever you want to call it, kind of thing. And then Nvidia is like a tech stock once again. So a lot of tech stocks in the US VTI market. So a lot of exposure to that, but we also have exposure to a little bit of everything in here as well, as you guys will see later on. So going into XIC, we have a little bit of different exposures here. So the #1 stock is going to be Shopify, which is a tech-based stock. And then we have RBC Bank of Canada, TD Bank of Canada, CNR National Railway, Enbridge, Brookfield, Bank of Nova Scotia, Bank of Montreal, Canadian Imperial Bank of Commerce, and then TC Energy Corp here. So we have lots of financials here, and that's pretty common in the Canadian market. And if we go, I'm just going to go down here to show the different sector breakdowns. This will give us a better idea of the diversification inside these funds. And this is why I think it's important to consider both these funds inside your portfolio, because you want a fund long term that's going to have exposure to a little bit of everything, just in case if something happens, right? If there's a financial crisis, you don't want to have all finance stocks, because you can take a big hit inside your portfolio. You kind of want a little bit of exposure over time, right? Especially as you get older and you might be living off your portfolio, or you might have less income to kind of counteract the different swings in the market. So we'll start with the VTI here. So here's a different portfolio composition. So the total stock market ETF, basic materials is 2%. And this is basically saying that 2% of the fund is basic materials. 15% is consumer discretionary, so that's consumer stocks. 4% is consumer staples. Energy is 2.5%, which is really low. So you can see the difference already here. Financials is 11%. Healthcare is 13%. Industrials is 13%. Real estate is 3%. Technology is 28%, like we kind of seen is the bulk of the portfolio. Telecommunications is 2%, and utilities is 2%. So you're going to see that almost like the Canadian market is kind of like the complete opposite of the US market. So, but one thing to take point about VTI, it's a nice broad-based fund. There's a lot of different things. Even though tech is 30% of the portfolio, it's really not a big chunk. We have it spread across most of these different industries. Going down here to XIC, which is on the right side, we can see that finances is 31%. So right there, already finances is the number one thing. We have energy, which is 12%, industrials, which is 11%, information technology, which is tech, at 11%, materials 11%, and then some other ones here at the bottom, telecommunications, utilities, some other things here. So the cool thing about XIC is it really is a total market fund for the Canadian stock. So it's kind of almost like the same thing as VTI, but it's the Canadian version. If you were to show some other Canadian ETFs, most of them would be heavily, based in finance stocks, because those are some of Canada's best stocks in my opinion. But this XIC really tries to mimic that total market. So you kind of get a little bit of both from each one. So you can see that they're both trying to give you exposure to a little bit of everything. And just to do a basic analysis of all these different stocks that both these funds hold, these are all good quality stocks. So once again, looking at the portfolio holdings, you can feel pretty comfortable. You have lots of diversification, and you could literally just buy these ETFs. So if you wanted to get exposure to the US market, you could literally just buy VTI and be fine. If you want to get exposure to the Canadian market, you could literally just buy XIC and you'd be perfectly fine. And that's why I like both of these funds. So the third thing I want to discuss really quickly is going to be the dividend yield of these two different ETFs. Now, the dividend yield for most total stock market ETFs is going to be a little bit on the lower side because we're focusing on growth and a lot of just really solid companies. And you're going to get a mix of everything. And traditionally in the US market, if you look at like the S&P 500, VTI, all these different funds, they focus on a lot of stocks that actually have very low dividends because they want to focus on companies that are growing, companies that are putting a lot of money into that stock growth appreciation. That's where you're going to get most of your gains from. Nonetheless, over time, the dividend yield does add up and it does compound and grow, and it does add a lot to your returns long term. So VTI, the dividend yield is 1.21%, which is a little bit on the lower side, and it is paid out quarterly. Now, XIC has a little bit of a higher distribution yield. On BlackRock, the distribution is currently saying it's about 2.47%, and that's probably mostly because Canada has more dividend-based stocks, like a lot of the finance stocks, the bank stocks have a little bit more established dividend yields, so that's what's kind of pushing it up. Nonetheless, 2.47% is a pretty conservative dividend yield, especially for a total market fund. But that's because, once again, you're getting a little bit of everything. You're getting some stocks that pay dividends, you're getting some stocks that don't pay dividends, you're getting some stocks that pay low dividends and are growing their dividends. You're getting a little bit of a mix of everything. So VTI has the lower dividend yield, which is paid quarterly, and XIC has the slightly higher dividend yield, which is paid quarterly, but they're both pretty low, and they're more focused on dividend growth and reinvesting those dividends over time and getting that stock appreciation. That's where most of the returns come from these two portfolios. Next part of the video, we're going to focus on probably the most important thing that you guys are kind of waiting for is what is the return of both these funds and which fund has performed better. Now, traditionally, if you look at the returns of most funds, US stocks, generally speaking, over time have performed better than Canadian stocks, but keep in mind, it changes on a regular basis. Like, for some years, Canadian stocks perform better, for some years, US stocks perform better. And you're going to see that over the past 5 to 10 years, US stocks have definitely performed better. And if we go all time, you're going to see that US stocks have outperformed Canadian stocks. Now, keep in mind, this can change at any point in time, and they do have times where, like over a 5-year period, maybe Canadian stocks perform better, and then maybe it changes and US stocks perform better. So it's important at the end of the day to kind of get the value of both. And I'll tell you as we get through this video, there's one thing I want you guys to know is that it's important to hold and have exposure to both of these two, but it's important to also understand which one is the better performing fund, and then you guys can decide how you want to weight your portfolio with that. So the first thing we're going to talk about is going to be the US fund. So if we go here on Google, we're just going to do a quick little peek. We can see the different return over year to year. So over the past year, VTI is up 34%, which is absolutely crazy. Over the past 5 years, it's up 106%. So what does that mean in numbers? Well, if you had $100,000 over the course of 5 years, that $100,000 would have grown to $200,000, would have been $20,000 a year you would have made on average. Pretty crazy stuff, right? If we go max all time, we can see that the VTI total stock market index fund is up 297% since 2001. So over the course of roughly 20 years, you would have been up 300%, which is pretty crazy. If we go to the right side and we take a peek at the Canadian fund, we can see that over the past year, XIC is up 26%. So a little bit under VTI, but nonetheless still pretty good. 26% is nothing to laugh about or to joke about. Over the past 5 years, XIC is up 40%, and this is where you're going to see the big difference. So VTI was up 106%. 106%. XIC is up 40%. And most of that came from the big dip that happened last year. So one of the things, it's important to see that US stocks have definitely outperformed Canadian stocks over the past 5 years. We've seen that. Nonetheless, it's important once again to have exposure to both just in case, because it could flip, where maybe over the next 10 years, Canadian stocks perform better. And 10 years is a long period of time. So it's important to kind of you guys to just do what you guys think is best and make your portfolio kind of cater towards what you want to do. But if we go max all time, and both these graphs kind of go over the past 20 years, we can see over the past 20 years, VTI is up 297%, like I mentioned, and XIC is up 160%. So VTI, the US market, almost doubling what XIC has performed, which is the total Canadian market. So once again, important things to consider when you're building your portfolio is definitely the overall return of these funds. So if you kind of want to get the maximum growth, you want to get the maximum benefit, you might want to consider putting US stocks inside of your TFSA, putting them inside of your personal account, whatever it is you're holding, because you're going to get a bigger return. However, keep in mind, it does depend on, the way the different markets are going. You can see over different periods of time, sometimes US stocks perform better, sometimes Canadian stocks perform better. You want to have exposure to both, but it's up to you to decide how much you want to have and how much risk you want to take and how comfortable you are with the different swings in the market. And to just give you guys an idea of the yearly return, this is important to look at as well. And this is only the past 5 years, so it's not a huge significant example of this, but you're going to see in terms of security and safety, which funds actually kind of sway the most and which ones are going to make you feel the best during periods of, let's say, crashes or pandemics or anything like that. So over the past 5 years, VTI, here's the total return. This column right here on the right side is going to, or actually this column here on the far right side is going to be your total return we're looking at. So 2015, VTI returned 0.4%, 2016, 13%, and 2017, 22%. 2018, we've seen a -5 return, so your portfolio would have dropped -5%. Over 2019, a whopping 31% return, and then 2020, 21% return. Now, we look over to XIC, here's the different returns. So 2016 was 21%. So we actually got a bigger return in XIC than the US market, which was 12% return. Interesting. 2017, XIC got a 9% return, while the US market got a 21% return. In 2018, XIC got a -8%, while VTI got a -5%. So it's almost showing that, interesting enough, the US market is almost more stable and more secure, and you're going to get less swings in terms of the negative than the Canadian markets. At least over the past 5 to 10 years, we're kind of seeing this. So once again, it's always important to consider this stuff. Just because a fund has more growth, it doesn't necessarily mean it's more risky. It just depends. So I always like to teach you guys it's important to kind of look at that yearly return and just kind of imagine, like, am I okay with my portfolio dropping 5%? Am I okay with my portfolio dropping 10%? These are definitely things you have to consider. So at the end of the day, if you guys were to ask me what fund I think is better, it honestly just depends. And I don't think it's a comparison of saying like, okay, one fund is better than the others. I think these are two solid, good quality funds. And I think every investor should be exposed to both of these markets. I think as a Canadian citizen, it's very important to be exposed to some Canadian stocks, but I also think it's very important, as you guys can see in this video, that US market is one of the best and fastest and the best long-termist growing market that's been out there. Like, the US funds have performed have given us basically some of the best returns possible in the stock market. So it's important to consider them, whether it's in your TFSA, your RSP, or your personal account. So at the end of the day, my approach, I would say, is to kind of expose yourself to both of these funds and just try to decide for yourself what you think is best. If you want to go for the most long-term biggest gains, you might want to favor more US stocks. So maybe you'll go like 60% US stocks, 40% Canadian. If you think the value is in the Canadian stocks, you might do the complete opposite. At the end of the day, I do believe you're going to want to mirror some type of approach. And my approach to this is a 60-40%. That's kind of what I've adopted, which means I like to have 60% of my stocks in US growth-based stocks and then 40% in Canadian stocks. And I've kind of mimicked this inside my TFSA. And going forward, I probably will do the same in my personal account as well. Anyways, guys, I hope you guys enjoyed this video. Let me know what you guys think in the comments. If you guys enjoyed the video, please give it a big thumbs up and remember to subscribe if you guys want to see more Canadian-based investing content. And if you guys have any questions, feel free to let me know. I'll try to get back to you guys as quickly as possible. Take care. Hope you guys enjoyed the video and enjoy your weekend, and I'll see you guys later.